Welcome to the deep dive. The financial world, it feels like it's constantly shifting under our feet these days. The architecture we've all relied on, well, it was designed for a different era, and it's really grappling with the pace of change. Traditional portfolios, they need to evolve.
Absolutely. And, the heart of that evolution isn't just some new tech fad. It's this fundamental idea that digital assets might actually represent a natural progression for money itself. They're built to serve those core functions: store of value, medium of exchange, unit of account, but using the tech we have today. That fundamental shift, I think, is what makes assets like Bitcoin increasingly, essential to understand.
And that brings us right to the core question, doesn't it? The one we really dug into in a recent analysis we worked on. For investors, especially the institutional ones, how much Bitcoin actually makes sense to hold, inside that traditional portfolio structure.
Exactly. And our goal, it really wasn't just speculation. We built a pretty rigorous, actually deliberately conservative analytical framework. We combined looking back at the hard historical data with running quite extensive forward-looking simulations. The point wasn't trying to forecast Bitcoin's price, not at all. It was really to understand its strategic role, within disciplined, risk-aware portfolios. So this deep dive is essentially walking you through that analysis.
Okay, so let's start with the historical picture then. Our analysis looked back at how adding Bitcoin would have actually impacted a standard traditional portfolio. Think something like a 70-30 mix, stocks and bonds, over the past decade or so.
What we found was pretty compelling. Even relatively small allocations to Bitcoin, we're talking just a few percentage points here, they didn't just add marginally, they actually materially improved returns and enhanced diversification across that whole historical period. It wasn't a subtle effect.
Yeah, and here's where it gets really interesting for me. When you look at those traditional portfolios, like the familiar 60-40 or 70-30, on paper, they look diversified, right? Because you've split the money between stocks and bonds. But in practice, sometimes they can be surprisingly concentrated in the underlying sources of risk and return. They often kind of move for similar big picture economic reasons.
Precisely. And this is really where Bitcoin offers something, quite unique. It helps diversify those fundamental sources of risk and return. Its price movements, its drivers, they're often pretty independent of what's pushing traditional stocks and bonds around. It brings an entirely new sort of independent dimension of return to the table, something traditional assets often lack. It genuinely spreads the risk rather than just, reallocating it among pieces that are already correlated.
Okay, right. So history gives us some powerful insights, definitely. But smart investing is always about looking forward, too. Your analysis didn't stop there, did it? You ran forward-looking Monte Carlo simulations.
No. We did, yeah. And we were very intentional about the assumptions we plugged in for Bitcoin in those simulations. We deliberately chose conservative scenarios, even kind of muted return expectations. We specifically factored in conditions you might see in a prolonged crypto winter, for instance. The whole idea was basically to stack the deck against Bitcoin to see if its value proposition for the portfolio still held up, even under those tougher, less advantageous conditions.
And what did those simulations consistently show, even when you made things deliberately difficult for Bitcoin?
What struck us really was the consistency across thousands and thousands of different simulated future market paths. The optimal allocations, the ones that best improve portfolio outcomes, they consistently fell within a particular range, around 2.5% to 5%.
5%, okay.
And this range, it didn't just boost the projected portfolio returns or improve the diversification metrics. Critically, it managed to keep the overall portfolio's risk levels within the kinds of familiar, acceptable boundaries that institutional investors are comfortable with, that they're used to managing.
Right. So the analysis isn't suggesting some kind of wild, outsized bet. It's pointing to a specific measured allocation range. But what about investors who maybe have a bit more tolerance for volatility, a higher risk appetite?
That's a good question. For those investors, the analysis does suggest that allocations could potentially stretch higher, maybe up to around 10%. But, and this is important, this becomes particularly powerful and frankly more justifiable when that allocation isn't just held passively, it's when it's managed dynamically.
Oh, okay. So that moves us beyond just buying it and holding it, right? The analysis suggests there's maybe a deeper opportunity with Bitcoin. What exactly does that mean?
It means you probably shouldn't just view Bitcoin as something you buy and then just tuck away somewhere. It should be actively managed. Think about it like this. In traditional finance, you wouldn't just leave significant cash reserves sitting idle in a basic checking account, would you? You'd put them to work. Money markets, short-term bonds, something to generate a bit of yield. Passive Bitcoin exposure, it's simple, it gives you the price beta, sure, but it might be leaving significant value on the table.
So it's about treating Bitcoin with the same kind of strategic thinking you'd apply to other reserves in the portfolio.
Exactly. And active management here, it isn't about reckless day trading or speculation. It's about responsibly enhancing value. It's about strategies aimed at generating yield on your Bitcoin holdings, potentially even increasing the amount of Bitcoin you hold over time, and reinforcing the overall resilience of the portfolio.
This connects back to Bitcoin's famous characteristic, right? Its volatility. Many people see that as just a huge negative, but the analysis seems to frame it, well, differently.
This is perhaps one of the most fascinating insights for us. Instead of just seeing that volatility as a bug, a problem to be avoided, we started to see it more as a feature, the raw material, if you like, from which opportunities can actually be carved out. And the key thing here is that Bitcoin's volatility isn't just an occasional flare-up. It seems to be structural. It consistently sits at levels that are multiples higher than traditional assets like equities.
And that structural volatility, you're saying, can actually be harvested, put to work.
No. Yes, exactly. There are a range of strategies. Everything from more conservative approaches like option premium harvesting, which essentially means selling the right for someone else to buy or sell your Bitcoin at a certain price in the future. And you collect a payment, a premium, for taking on that potential risk, especially when volatility means you get paid well for it. To more, let's say, aggressive strategies like perhaps pledging Bitcoin into specialized institutional grade funds, funds that might use systematic approaches like trend following, specifically designed to generate returns measured in Bitcoin. The goal there is actually generating more coin.
But the analysis also included a pretty clear warning label about jumping into this active management side of things.
It does, and it raises a really crucial point. Successfully managing Bitcoin actively, it's far from trivial. It's complex. It requires specialist execution. You need real-time monitoring of market conditions, precision in how you execute the strategies, dynamic risk frameworks that can adapt quickly as markets inevitably change, and frankly, very specialized infrastructure to avoid common operational pitfalls or security risks. Without that discipline and that deep expertise, what should be a potentially low-risk way to enhance yield can go wrong very quickly. But if it's done correctly, the reward can be profound. Your Bitcoin doesn't just passively sit there. It can actually grow and compound its own holdings over time.
Okay, so bringing this all together then, what's the big picture, the main takeaway from this whole analysis?
I think the core message that emerged is pretty clear.
Bitcoin really shouldn't be viewed as some kind of isolated speculative oddity anymore. Is that fair?
I think so. It needs to be seen and probably treated as a legitimate strategic building block for genuinely modern portfolios, something that's managed, monitored, and integrated with the same level of discipline and rigor as any other core asset class you might hold.
And the analysis shows that even relatively modest allocations, specifically in that, 2.5% to 5% range, can demonstrably improve portfolio outcomes. And it's not just about chasing higher returns. It's also about enhancing resilience, overall balance in what's clearly an evolving market landscape.
Exactly. It offers a pragmatic way, really, to introduce a new independent dimension of return into the portfolio mix. It's generally uncorrelated with traditional assets. It's decentralized. It's programmable. And arguably, it's fundamentally aligned with the direction that value transfer seems to be heading in the future.
And then beyond just passively holding it, that structural volatility we talked about provides another real opportunity, a chance for generating extra yield and maybe compounding holdings through disciplined, risk-managed strategies.
Ultimately, Bitcoin is presenting itself as a strategic tool.
And if you approach it thoughtfully, with the right analysis and the right execution partners, it seems it can absolutely help build stronger, smarter, and importantly, significantly more future-proof portfolios.
Which, I suppose, leaves us with an important question for you, the listener. Based on this kind of data-driven approach we've discussed, how will you think about evaluating potential new strategic building blocks? Not just Bitcoin, but anything new for your own understanding or investment framework going forward. The question really isn't just if Bitcoin belongs in the conversation anymore. It's more about how much sense it makes for a given portfolio, how thoughtfully you assess its specific role, and maybe how actively you choose to engage with its potential.